live.
Cool. Okay. Cool.
Hello, for those who are watching the recording. My name is James Blair, Wealth Director at Lighthouse. I am joined by Michael Vincent, who is our Mortgage Director at Lighthouse. We will give it a few minutes before we start today's webinar, which is, Mike, what is it all about? Paying down debt, creating wealth, achieving the dream.
I know, counterintuitive for a mortgage broker. I just want you to take out more debt.
You're a good guy though, Mike. So we'll just give it a few minutes while some people join us and while we get set in for the session.
Do you want to chuck the Slido link in our Slack and I'll just pull it up on my phone?
I put it in the Zoom.
I know. And you chuck it in our Slack. Cool, got it, thanks.
No worries. Oh, we've got Judy that has joined us as well. Judy, I know you can hear me. We've already gone live on YouTube. So just a heads up in case you go off ranting about something as soon as I let you talk. Hi, Judy.
Hello, sorry, I'm not late. I'm a minute early. You guys are just very early.
Yes, we are organized, ready to roll.
I love it. Happy hump day.
Happy hump day to you as well.
Yeah.
Awesome. Well, shall we give it the next 2 seconds or 30 seconds or whatever we've got till 2 o'clock and then kick things off?
Yeah, sounds good.
Amazing.
Yep.
Oh. Good.
Okay, hello those that have joined us. We'll just give it a minute or so and then we will crack into it.
Amazing. Yeah, so thanks very much for everyone who's here. I have got no idea who is here because I can't see it, unfortunately. But yeah, look, just wanted to say this is the second session we're running, aimed more at mid-career, so looking at paying down debt and also building long-term wealth, which I think is something that we're all really passionate about. And if we can get to a point where we don't have to work, then it'll make my job harder, but make everyone else's life nicer. So
of course you don't do it for the money, Judy, right? You're there for the love of the job.
I'm skilled, mate. I need all the help I can get. But yeah, so look, thank you so much again, James and Michael, for being here and sort of sharing your insight and your wisdom. I'll hand over to you guys and let you kick things off. But yeah, thanks for being here.
Great. Okay, thank you for that very much, Judy. We will remove you from being a host. We will share our slides to get the show on the road. Hello, everybody. My name is James Blair. I'm the Director of Wealth here at Lighthouse. Michael, do you want to introduce yourself?
Okay. I'm Michael Vincent. I'm one of the directors of the mortgage team here at Lighthouse as well.
Great. Okay, thank you. That just gave me a second to move Judy off the call. Yeah, so awesome to be here for part 2 of 3 for Secure Your Financial Future. Just a quick reminder, Michael and I have run these webinars with lots of really large businesses, taking about 4,000 people through these webinars. But you don't care about that. You care about you. You care about your future, where you want to go, what you want to achieve. And we are here to talk about all those things and make them happen. So today, the topic is securing your financial future, paying down debt, and creating wealth. So Mike and I will probably talk for 30 to 40 minutes. We will try and be well behaved. At the end, there will be as much Q&A as your heart desires. There are 2 ways to put questions in, which we encourage you to do as you go. So either you can use the chat function on YouTube, or in the description of this video, there is Slido where you can put anonymous questions if you would prefer to do things that way. A little bit about Lighthouse before we jump in. So Lighthouse is a full services financial advice firm. So we have accountants, mortgage brokers, insurance brokers, and wealth advisors. Our purpose at Lighthouse is to secure your financial future. So that means we're all about thinking long-term, buying long-term assets, getting the benefits of compounding interest. And we also believe that financial literacy, which is what today is about, plus action equals financial freedom.
Cool. So just like yesterday, we've got a disclaimer. Again, this isn't personalized advice. We're just talking in general terms. If you do want to discuss your personal situation, book a time with James or I. We're happy to give you all the advice that we need. Much like yesterday, we'll keep answering questions as much as we can, to as much detail as we can. But if it does get to the point where we're starting to give personalized advice, we'll just ask you to book in a time to sit down with us. Cool. So the agenda. Today, we're going to look at setting goals and budgeting. We did that yesterday for those who were on yesterday's call, but in this episode, we'll probably put a bit of a different spin on it. We'll look at paying off your mortgage, which is counterintuitive for me as a mortgage broker. I want you to have more debt. We'll also look at creating wealth and then KiwiSaver and insurances as well. But all of that is in a slightly different lens to yesterday, because now we're looking at reducing debt and also building some wealth over the long term.
So this is one of my favorite slides, Mike. And what we believe here at Lighthouse is there is no quick get rich quick schemes. We don't believe in those, do we, Mike?
No, not at all.
I mean, unless you've got some lotto numbers or an inside word on a crypto coin that's about to go to the moon, you can email that to michael@lighthousefinancial.com.
Yeah, that hot stock tip, yeah.
We believe that creating financial freedom can be quite overwhelming at times, but taking small, consistent steps over time can achieve that goal. And it's like a snowball going downhill. It builds momentum. You go, I feel very far away. 5 years, you're like, holy tamale, we're making some momentum. 10, 15 years, you're talking life-changing. So small, consistent steps over time. So we're going to start with some stats like we did yesterday. Again, the main stat, the reason why we do these webinars, 46% of Kiwis are unsure about making a large financial decision or about their financial future. 80%, what is this? Even larger stat, this is the percentage of your income that you're going to need moving into retirement. Quite often we hear people say, oh, hey, look, when I move into retirement, I'll sell the house, I'll stop working, I'll stop spending money. That's not usually how it works. You usually need about that 80% mark, at least in the early years of your retirement when you're still active. 3 years, what does this mean? This is the amount of time that you will save on your mortgage, pay it off early if you contribute $100 a week extra. We'll run through this in a bit more detail. We've got an example to show you, so we'll touch on that shortly. And then 20%, this is the number of Kiwis who have income protection insurance. Your ability to earn your income is probably one of your biggest assets. Almost nobody insures it, as you could see, and it's a real flaw in people's financial plan. It's the same as having like a will, right? Everybody should have a will. Everyone should have the right insurances. Everyone thinks they're bulletproof until they ain't, and then it's too late.
Yeah.
Okay, so I'm just going to quickly stop for a second. For those that have joined us late, because it looks like there's a few that have jumped in a little bit later, a reminder that I want lots of questions as we go for you to get exactly what you want out of this session. Pop questions as we go into the live chat on YouTube, or in the description of this video, there's a link to Slido where you can put anonymous questions. Mike, we want to get flooded with questions, don't we?
Yeah, I think our record was Rocket Lab did an hour and a half of questions after one of these.
Yeah, we needed to drink after that.
Yeah. Okay,
so before we spoke about this yesterday for those that attended on buying your first home, but today's the kind of person, and this won't be everybody, maybe you've got a busy job, maybe you've got a spouse, maybe you've got some kids, you're trying to keep up with your friends, you're trying to do your hobbies. But then in the background, you're thinking about, what is my future? What do I want my lifestyle to achieve? What am I trying to achieve? So the old saying going, I've got $100,000 or I've got $10,000, whatever, where should I invest it? It all depends on what you're trying to achieve. So a little bit of goal setting 101 and what we do as financial advisors when we create a financial plan is there's 3 steps. The first step, think about the lifestyle that you're trying to achieve. If money wasn't an objective, what would you want to do? How would you want to spend your time? What would that look like? That might be the location you're living in, the house you're living in, the people you're spending your time with. Are you traveling? What are you doing for work? Then once you've got some high level ideas of the kind of life you want to try and build, then you need to put some what we call SMART goals around it, get a little bit specific. So that's the value of the house, the income that you want. Are you going to travel like me, who is very prudent and sensible, or Mike, who is just balling in private jets going to the south of France? How are you traveling?
If you pay for a breakfast, I might not have so many expenses.
How are you spending your time when you're traveling? What age do you want to retire? If you want to retire earlier, you need more money. That's simple. Then once you've got the big goals, the specifics on those goals, you need to work it all the way down into, what do I need to do each fortnight, each pay cycle to take small, consistent steps towards those goals? Am I on track to achieve those goals? And if you are on track, if you're not on track to achieve those goals, what levers can you pull to achieve them? Maybe you're going to retire later. Maybe you're going to drop the income. Maybe Mike is going to only go first class instead of a private jet. There are levers we can pull so it is achievable. Here are a list of pretty common goals that we see. A lot of people say to me, James, I love my job, but I don't want to be tied to it. I just want to know that if I decided I wanted to change, I could have one. I don't need the income. So financial freedom, passive income, peace of mind, helping kids, early retirement, helping kids with like school fees, university fees, travel are all pretty common goals we see.
The early retirement one is a bit of an interesting one. We actually get this as probably the most common goal, but James sort of talked about really thinking about what these goals mean to you, and early retirement's a really good example of that. Look, early retirement might not mean that you stop working. It might mean that, you only work a couple of days a week. You do some consulting. It might mean that actually maybe you retire from the job where you make money, but then you go and do something that you actually really want to do. You might have always wanted to work outside or work with animals or something like that. There's a lot of different thought or sort of different scenarios that can play out from just one thing like early retirement. So it's important to put a lot of thought into these goals. They can be adjusted over time, but you shouldn't just be pinning early retirement on the wall because it's a convenient one.
Yeah, and to achieve that early retirement goal, you might be sacrificing things. You might be sacrificing things you could do now for a future lifestyle. So you need to think about, what would you do in that future lifestyle that you're not doing now? One other really important point to talk about when it comes to a plan and goals is you will go, this is what I want to achieve, but then life will happen and things won't work out exactly as you want. And I tell people, some things work out better, some things work out worse. You get to the same destination, but the path to get there just looks a little bit different.
Yeah.
Now, coming back to budgeting, which we touched on yesterday, I hear the same thing a lot of the time. James, I'm not spending lots of money on clothes. I'm not going out for expensive dinner, but all the money disappears. I don't know where it goes. Harnessing your budget, knowing where your money is being spent, prioritizing the things that are important to you is really important if you're in that kind of mid-career, lots of things going on, because it's so easy for money to slip here and there, and it, at the end of the day, adds up to a big number. So there are a million different ways you can budget. Here's a nice simple way with some automatic payments where you get paid and it automatically gets split into these kind of accounts or however you'd like to structure it. Now, you might have a spreadsheet that you like, and if you like that, that's great. We really like the online tool Pocketsmith, which is just so easy. It's like $10 a month to use. But the idea is, first, you need to know what your fixed cost of living are. What is your mortgage, that gym membership, that kickboxing membership Mike has to turn himself into a killer, power, electricity, petrol. Bloody hell, Mike, that's taking up more of a jar than it did in the past. Understanding your minimum cost of living, making sure we're putting a little bit of money away each pay for an emergency fund. Now, an emergency fund is not a floating loan or something with mixed purpose. This is like your break glass here when life goes wrong. And this is really important because life will go wrong, and it gives you a little bit of swag in your step to know that you're going to be okay if something happens.
Yeah, and we do actually see a lot of people who use their revolving credit facility or a credit card as their emergency fund. And ideally you wouldn't do that. It's a very different feeling to know that you actually have cash sitting in the bank when something goes wrong. You can pull that out and use it. You're not relying on a credit card. You're not relying on an overdraft. You're not relying on a bank to give you the funding. It's your own money sitting there.
Yeah. And then we've got the fun jar, which is important because if you can't have a bit of fun, what's the point of it all? Now, the fun needs to be, the fun jar is essentially what will stop you from achieving your dreams earlier and your goals, but you need to have some fun because you won't get there otherwise. Life isn't worth it. So it's about finding that balance. And then the savings jar might be paying off your mortgage faster, paying for an investment property, investing into some shares, starting your own business, whatever. That is the only jar out of the four that is helping you move towards financial freedom. That jar needs to be getting some love.
Yeah. And as James has sort of been subtly hinting at, perhaps I like spending money a little bit too much. So, there are ways that you can do this and you can set this up. But if you're like me and perhaps you keep tapping the credit card a bit too much to sort of help this along, right? And we talked about this yesterday, but keeping it automated is a really important thing. You don't want to be manually moving this money around. It means you are more likely to go, savings is looking all right, funds looking a little bit low, might have a bit more fun this month or something like that. The other thing, if you are a really bad saver, put it in another bank. If your transactional bank is Westpac, put it in an ANZ saving account. The interest is going to be negligible either way, so it's not going to matter. It's about having convenient access to that money and taking that away. Cool. So debt-free on your own home. Why would a mortgage broker be telling you to do this? I'm also a financial advisor. So becoming debt-free on your owner-occupied property is a really common goal that we see from people. And it's important because, although it is good debt to a degree, it's a house that you live in, it's an asset, it's something that you do want to make headway paying off. So it's not hanging around when you're looking at retirement, you've got no equity, you need to keep working longer. All of that isn't ideal. So let's say I've got $100 a week extra that I can put on my mortgage. What's the big deal with that? Now, let's say I've got an $800,000 mortgage. It's on a 4% interest rate. Those rates do still exist. And I'm paying $2,000 a fortnight in repayments. What does this $100 a week extra actually look like? And none of these seem like big steps because remember, wealth is like a snowball. Small incremental things will build up over time. So you will end up paying your mortgage off 3 years earlier. Now, you might be listening to me going, Mike, 3 years doesn't seem like much. What does it matter? So if I took that $2,200 per fortnight that I was paying onto those loans, put it in a savings account at that same interest rate, 4%, over 3 years, I'm going to get to 185,000. So year one, round about 60, year two, 121,000, year three, we'll get to that 185,500. Now still, you might be going, Mike, I'm just saving for 3 years. I can do the math, that works out. If you stop contributing at the end of year three and leave that sitting there in that 4% return savings account for another 10 years, you're going to get 264,000 by the end of that time period. So it shows you the power of making small steps over time, compounding interest. We believe that compounding returns are one of the largest forces in the financial universe and a real key to unlocking wealth over time. This is an example to show you can make a small change for a big outcome.
I'd say, Mike, out of any universe, compounding returns are one of the greatest forces.
The Marvel universe?
It is quite hard sometimes, even in finance, to get your head around like interest on interest on interest over time, how big of a difference it can be. And with your mortgage, it's the flip side, right? Isn't it, Mike? That as you clear the mortgage, you're paying less and less interest and paying more and more principal off your mortgage.
Yeah. So now remember, guys, these are all just examples that we have sort of come to where to illustrate a purpose to you, right? And you might be looking at this and going, yeah, look, I don't have $100 a week right now. That doesn't work for me. You can apply these numbers to your own situation. But let's say, if you can do $50 and not 100, great. If you can do 20 and not 50, it's still doing something, right? But let's say you say, oh, look, I can't do 200 a fortnight now. How does this work out? Now, let's say you're earning, on average, $80,000 over your career. You get a 3% pay rise per annum. And again, you're going to be thinking, Mike, no one gets a 3% pay rise per annum. This is an average. Some years you get a promotion. Some years you get a bit less. Let's say you take half of that money and put it towards your present day you. So you just spend it, and you take the other half of that money and you put it on your mortgage. Over 15 years, that's going to equate to around about $350 a fortnight. So again, over time, making these small steps as you get a pay rise, keep half now and put half on the mortgage or something like that, can actually really sort of build over time and make you significantly better off. So the next thing that's going to be counterintuitive, should you upgrade your home? Now, as I talk through this, just keep in mind, I'm not saying you shouldn't upgrade your home. There are definitely certain circumstances where you would want to upgrade your home. Maybe you've got some kids on the way, you don't like the area, you want to get into a better school zone or something like that. But when you do make this decision, I want you to make this decision with some numbers behind it and really just thinking about what this could actually mean.
Oh, I love this slide, Mike. It is great. You're right. You might move anyway, but information-wise, awesome.
And it's just about knowing exactly what that means for you on the long term, right?
Yeah.
So
informed decisions.
Yeah. So let's say you're 35 years old. You've got a house worth 1.5 million. You've got a $500,000 mortgage. You and your partner earn 100K each. You're spending 80,000 on expenses and bills and 50,000 on a KiwiSaver. So let's say at that point in time, you decide to upgrade to a $2 million house. Now, that's going to take you 24 years to clear that mortgage on the minimum repayments. You will have $1.3 million of assets by age 65. And we calculate that you can generate about a $65,000 income in retirement. Now, let's say you stay in that current home. It is likely you will pay off your mortgage in 10 years. You'll have $2.4 million of assets by age 65. And that would be generating $100,000 of income per annum in retirement. So again, I'm not saying you'd have to stay in your first home for the rest of your life. That's not realistic at all. But it's just about thinking on the long term. Is this the right decision? Am I moving for the right reasons? What does this mean for me?
If I can jump in there as well, Mike, and we see it all the time, right? People trying to keep up with the Joneses, having FOMO, people making decisions based off emotion or the barbecue chat or whatever. We're not saying do these things or don't do these things, because this is not personalized advice and it will be based on your own situation. But it's about making informed decisions and going, okay, this is really important to me. If I do this thing, these are the long-term impacts, and it is what it is, right?
Yeah, and we have customers who do both things, right? Where we give advice to do something. We have a joint customer who've given advice to buy an investment property, and they've sold all their investment properties and their property, and they've bought a larger owner-occupied home. They are moving because they need more space for their dogs, but they still think they need space. Yeah,
that's great. Hey, Harry the pug has a lifestyle he's accustomed to and needs his space to play. So I can relate. So I'm just going to stop there and give a couple of shout outs. Jules on YouTube, and then a couple of anonymous questions on Slido. Thank you for putting those questions in, which we will tackle at the end. If you have any questions around clearing your mortgage, upgrading your home, chuck those questions in now so we can tackle them at the end, okay?
Yeah.
Now, the big part, this is where we start getting all technical, talking about iron butterfly spreads, how there's some way that you can get lots of investment properties with no income. That's not what we're doing.
Maximum upside, very little downside.
Yeah. I've got a huge opportunity for you. So we believe with creating wealth about keeping it simple. We're simple people, Mike and I. No offense, Mike, throwing you in that camp. We like to keep things simple and consistent over time to achieve goals. And that is because, why, Mike? Wealth is like a snowball. Small, consistent steps over time help you live the life that you dreamed of. Now, we're going to talk about how to create wealth in a scenario where we talk about my very new wife and Mike's fiance, Christina, in two different examples. And then we'll talk about some learnings as we go. So here are two couples, myself and Hannah, both 35, incredibly youthful for 35, I must say. Joint incomes of $260,000. We've got our house, we've got our mortgage, we've got our KiwiSaver joint balances, contribution levels for KiwiSaver. Mike, we're going to have to update that interest rate. But a 3%
you can still get it.
Yeah, talk to Michael if you want a 3% interest rate guarantee. So here are two examples. The difference is that Mike and Christina have attended one of the Secure Your Financial Future webinars and are taking control of their future. So Hannah and I are making the minimum mortgage repayments. We don't know where our KiwiSaver is. We're not doing anything with our money. We're just kind of getting by, chipping away at our mortgage. Mike and Christina, though, they are making much bigger mortgage contributions because each year they get a pay rise. They're increasing their mortgage contributions. They thought, hey, I've got quite a bit of equity in my home. I'm going to buy an investment property, which Mike can touch on in a second. They've made an active choice of their KiwiSaver fund and provider because KiwiSaver is one of your biggest assets come retirement. So it's important you take it seriously and decide who's looking after your money. So they're getting a bit of an extra return. And then Mike and Christina are also diversifying, contributing to an index fund, contributing $500 a week.
I think it's, I'm just going to jump in for a second there. On the KiwiSaver return, that 4% versus that 3%, how long is that conversation? It's like a half-hour conversation to sort out your KiwiSaver, right?
Yeah, I mean, I don't want to simplify what I do too much, but as I said, I'm a simple man. You can make an active choice on your KiwiSaver very quickly. I guess that 80% of the people on this call probably have their KiwiSaver with their bank. Is that the right place for them? Maybe, maybe not. But you should be making an active choice and just getting comfortable with how it's being invested, who is the provider, and what level of risk are you with.
Yeah.
And actually, on a side note, we're seeing that quite a bit at the moment with what's happening with Russia and Ukraine and the likes, where KiwiSaver balances have dropped a little bit, not a huge amount in the scheme of history, a little bit. And the amount of people that I'm already talking to have gone from growth to conservative, where they've locked in their losses. Worst thing you can do for yourself.
Yeah.
So back to this situation, Mike and Christina, they're doing well. I mean, they're not lighting the world on fire. They're doing some good stuff. Me and Hannah doing the minimum. Over 10 years, it's like a snowball. Small, consistent steps over time make a big difference. So we're in the same houses. So the value of our houses has increased 5% per annum. My mortgage and Hannah's mortgage is $800,000. But Mike and Christina's is $550,000. They've cleared an extra whopping $250,000 off their mortgage. Mike, excellent job by you. They've also got an investment property, which has increased 5% per annum. It's interest only. It's a long-term buy and hold. They've now got $500,000 of equity in that property. Their KiwiSaver balances are a little bit higher, but that'll continue to compound over time. And their index fund is worth $350,000 now, which equates to a difference of $1.1 million by doing a few small, consistent things over time.
Yeah. So you might be looking at that and going, small consistent things, these sort of things, again, especially with the likes of the $500 a week into an index fund, and thinking that is probably too much for me to do. You don't have to pull all of these levers at once, and you don't have to do it all to the maximum amount. What we're trying to stress here is something is better than nothing, and the more you do, the better.
Yeah, and you don't know what your financial position is going to look like in 5 years, 7 years, 10 years time. You can increase those contributions, build more momentum as you go, reflect on your budget, all of those sort of things. And Mike's right, this scenario has good incomes. There is some good starting points, but all of it is reflective to your situation as well and what you might be able to do now or in the future.
Yeah, and don't think that we are sort of overlooking the stress of day-to-day life and money movements and expenses and these sorts of things. You can adjust these things up and down. You can compensate when things go a little bit wrong and adjust the plan. But that's why having a plan over the long term is a really important thing.
Yeah. So like, if we look at this breakdown, the house value is the same. The mortgage is $250,000 less than it was. So at a 5% interest rate, you're saving like 25 grand a year in interest on the mortgage. That's that's essentially what Mike and Christina are contributing to the index fund, which they've done from the start. But you can see how money can be redistributed or can go harder towards the mortgage. Mike, we're going to touch like in detail on investment property tomorrow, but do you want to maybe give like a really quick breakdown around how you and Christina in this example have got an investment property?
How to buy an investment property, James, you're speaking my language. Look, so essentially what you do is you use the equity that's built up in your owner occupied property, which is one way you can do it, equity that's built up in your owner occupied property to leverage into another property. Now, when you're purchasing a house, the bank will say you need at least 20% deposit. They're not actually after the money. They just want to keep the value of the lending against the value of the houses below a certain level. Now, what you do is you take the equity from your existing property, so that what the bank's really looking for, and you join those two asset pools together. So really all you're doing is taking out more debt, but keeping the relative ratio of debt to house value at an acceptable level for the bank. That is a somewhat complex way of saying you use your existing house to buy another house. Now, things you look at there are the rental return that you're going to get, the type of property you're buying, probably a couple of other factors in there too. Again, I will touch on this in a lot more detail tomorrow. But really, you just go to the bank and say, you've got my property already. I want another property. How do I do it? And I probably wouldn't go to a bank because they'll tell you no.
Slightly controversial statement. Not sure how you're going to feel about this, Mike. The only benefit of investment property, the reason why investment property is such an attractive asset is you can turn nothing from like just the security in your home into like $1 million asset, which can create capital gains over time. People go shares versus property. Shares, in my opinion, much more diversified depending on how you do it. Much more diversified than one particular property. But in the game where the bank will give you their money for you to use it to buy something else, pretty bloody attractive.
Yeah, if I think about that from a numbers perspective, if I buy a new build investment property at 90% LVR, which they're exempt from Reserve Bank rules, so I can use $100,000 of equity to buy $1 million property. That's really a no-brainer. So that's the major sort of advantage with property, is that ability to leverage up.
Yep.
So doing a little bit versus doing a bit. Really what we were looking at there, focusing on your budget, using that lazy equity or the equity you've got sitting in your home to buy an investment property, making an active choice about that KiwiSaver provider. I know I keep coming back to this, but it's a half-hour conversation that can potentially make a huge difference in the returns you have later in life. And I know it didn't look like a massive return in that example. I think it was only $20,000 difference. But again, these small incremental steps will build over time. Increase your mortgage repayments, on an annual basis, fortnightly basis, something like that. There's a number of different ways you can do that and structures that you can set up your loans to allow you to have some more flexibility there. But paying down your owner-occupied debt is something you need to focus on. And then contributing a small amount to an index fund. Doesn't have to be heaps. I know we use 500, but could be 50, could be 100, could be 20. Just, having some different areas of investment can really pay off over the long run.
So when you are making investment decisions and thinking about how you're creating wealth, here are the T's and C's that are really important to think about. So what are the fees and what are the costs associated to this plan? What are the returns that I'm expecting? If somebody is promising you the moon, you should probably run in the other direction. If there are higher returns, you need to be comfortable that there is more risk associated. Coming down to that point of risk, there is different types of risk. A well-diversified fund can drop 30% in a global financial crisis. A fund that is not diversified, just invest in one company, you can lose all your money. So understanding your levels of risk, making sure it's diversified to reduce some of your risk, and understanding your time frame to invest. If you're investing in index funds and you're wanting to buy another house in 6 months, or investing in crypto, want to buy a house in 6 months, the wrong place to be. If you're investing in investment property and want an income in the near future because you're about to have it start a family or retire, property may not be the right solution because you don't have the liquidity or the income because you're using debt. But like we said, these are not crazy things to do. It is small, simple, consistent steps over time. A boring, smart plan is my favorite way to go, where a client goes, geez, James, shouldn't we be doing a bit more? Shouldn't we be buying some gold? Shouldn't we be starting a side hustle? Shouldn't we be starting a business? No, keep it simple, unless for your situation, it might be the right thing to do.
Yeah, it's funny because we always get asked, like, what is the hot stock tip? And should I put everything in crypto? I'm like, look, we come back to wealth is like a snowball. A get rich quick scheme is an avalanche. It does not work for everybody. And more often than not, you are going to get burnt.
So we've spoken about growing your wealth, building the plan to achieve your goals. What are those goals? How are you going to get there? What does it look like? This is the depressing stuff, that it is possible that you don't get to your goals because you pass away early. It's possible you get sick, and that can have an impact on achieving your goals. So it's important that you protect your biggest asset, which is your income, your health, your ability to earn. Now, a lot of people say to me, well, and this goes with a will as well. You should definitely have a will, the right structure of your assets, all of that kind of stuff as well. Some people say, well, James, it's a waste of money. What if I never claim on it? If you never claim, if insurance is good value for money, I hate to break it to you, but something has gone very wrong for you. You hope that you spend this money and never have to claim on it.
Yeah.
Because unfortunately, like the slide shows, people do pass away, people do get sick. If you don't have your income, how are you going to achieve your goals, pay your mortgage, maintain your lifestyle? People like examples. So here's an example. Say Hannah and I are a couple in that same scenario we spoke about before, except I'm a stay-at-home dad. Hannah's out. She's the breadwinner. In this example, Hannah's got $2 million of life insurance to keep me in the lifestyle that I am accustomed to. She has income protection, and I have a lump sum if I get sick. Our fortnightly costs are $110. Mike and Christina are working equally in terms of income. So they've got equal amounts of life insurance and income protection. You'll notice that in this example, they are only clearing half the mortgage because Mike and Christina have good jobs and can continue to pay half the mortgage. So that's a couple of quick examples of how a life insurance quote or solution might work. If you only had $50 a fortnight to pay for insurance, you can get $50 worth of insurance. You just get less insurance, and something is better than nothing. Some protection, half your income if you got sick is better than no income if you got sick.
Yeah, and it's a bit of a sobering topic. And look, insurance is complicated, dry, and boring. I'm sorry to just say this about your job, James, but you know, it's both James and I have joint customers and customers separately where we've had phone calls asking if we can fix situations, and it's pretty difficult when we can't. I mean, it's difficult to fix be the ambulance at the bottom of the cliff, but when we can't and people end up selling houses and living with friends and that sort of stuff, it sucks. Cool. So key points from today. And this is the part where we're starting to wrap up. So if you have any questions, start putting them in Slido, start putting them on the links on YouTube, and then we'll cover them off at the end. James and I are happy to answer questions for as long as you want.
I got nowhere to be, Mike. I'll hang around as long as you want.
Cool. So look, key points from today, guys. Have a plan. Know what you want, and then take small steps on how to get there. So how are you going to achieve those goals? How are you going to grow their wealth? Really put some thought into this. just because you've got a plan doesn't mean you're never going to change it. You adjust these things over time. Maybe you work with a financial advisor to get a formal plan in place. Maybe it's something you do yourself. But if there's something you take away from today, it's have a plan, set some goals, so you've got something to work towards. Small increases on your mortgage make a big difference. Just think about the example I gave there. Yep, $100 a week, $200 a fortnight. If you can't do that, think about what you can do. We get asked, should I invest or should I pay off the mortgage and this sort of thing? And, paying down the mortgage is going to make a big difference over the long term. Think about those small steps you can take to grow your wealth over time. What are some different assets you can invest in? Should you be looking at property? Should you be looking at index funds? There's a lots of different things you can invest in to grow your wealth. Protect your family and yourself. Get insurance. I know it's boring. I know it's dry. I know it's complex for a reason. They don't want you to understand what's going on. But hope you never have to use it. But if you do, it's good that it's there. And look, we've said it before. Wealth is like a snowball. We're not asking you to go put the whole house on crypto or to do some, giant complex hedging strategy with some shares. That's not what this is about. This is about just taking small steps to achieve those goals.
So we're just about to do Q&A, so get those questions in. If you need some help taking the next step for you, we're here to help. If you've got what you need out of today's webinar, that's great. But if you want to have a chat with one of the mortgage team around whether you can upgrade your home, buy an investment property, you want to refix your mortgages, roll them over, whatever it might look like, in the link to this description, there's a link to our calendar to book a time to talk about your mortgages. If you would like a review of your life insurance, income protection, health insurance, reviewing your insurance, you can book a time as well. And then if you would like to talk about building a financial plan, KiwiSaver, investments, how to achieve your goals, there's also a link for that as well. We'd love to talk to some of you one-on-one. Also, you're on our YouTube page. If you are looking for more information, more knowledge to take control of your future, we've got like 80 odd videos on this channel talking about all things from paying down debt, investing, KiwiSaver. We're filming some podcasts on Friday around cryptocurrencies. We've got stuff on wills, pretty much everything you can think of. Subscribe to the channel so you can jump on later on and watch some more videos. And while you're at it, give this video a like as well, please. Okay, it is Q&A time, my favorite time of the day, Michael. There's a couple on YouTube, and then there's a few on Slido as well. Yeah, so cool. The first one is, at what point does the cost of income protection start outweighing the benefits as you get older? So it's a really good question. So insurance each year gets, for most people, more expensive, 5 to 10% depending on your age. And that's unfortunately because as you get older, you're more likely to need to claim on it. Just statistically, that's what happens each year you get older. Now, there are different ways you can make it cheaper, or your need for it might change over time. So for example, you might be at a point where if you couldn't work, you build enough financial strength that you don't need your full income. Maybe instead of insuring 75% of your income, you can insure 50%. That can make it cheaper. Maybe you don't need to be paid till age 65 as a benefit. Maybe it's only 2 or 5 years. Maybe you've built an emergency fund and you can have a longer waiting period for your insurance. I would say until you're at the point where you could retire tomorrow, you need your income protection insurance. But maybe you're at a point where you don't need all of your insurance anymore.
Yeah.
The next question is, what advice can you give to protect your KiwiSaver from a partner should you split up? Does this leave you vulnerable in having to pay out on this leaving you caught in buying a house later? So the short answer is you would either need a relationship agreement with a lawyer to stipulate that KiwiSaver is yours, or you would need a prenup if you were married, or some version of those two things. If they're not agreed beforehand or agreeing in hindsight, good luck with that. Pretty much if it's relationship property, it can be 50-50, right, Mike?
Yeah, so you need a contracting out agreement. Neither James nor I are family lawyers, but yeah, you need at least some sort of contracting out agreement in there to stipulate that it wasn't relationship property.
Yeah, we know lots of good ones though, and a really good example. I was just talking to this bloke this morning. He's in a good position. He's moved in with his new partner. They've got some joint assets. They've been together for a little while, but they're now thinking about building a joint financial plan. And I'm like, look, this is all great. I'm excited about your future. Let's go get the relationship property agreement in place, though, in case the worst were to happen, so we can talk about building a future together. Because if you don't get those things sorted at the start, it's always in the back of your mind.
Yeah. And if you need a relationship property solicitor, James and I can point you in the direction of one.
Yeah, absolutely. Next question. Definitely interested in how to rev up KiwiSaver to ensure a decent nest egg for retirement. With only 15 years to go, clock is ticking. I think that's more of a statement than a question. There's actually like a hell of a lot you can do in 15 years. So yeah, clock is ticking, making sure we're making an active choice on your KiwiSaver provider and fund. If you'd like to have a chat with us, we can talk one-on-one about what might be the right solution for you.
A lot of questions around insurance and investments. What about property?
Okay, I know you're not feeling the love, Mike. So should I help you? I'll give you, just to let everybody know, Mike, he gets a little bit jealous. He's a little bit sensitive. He wants the questions. So Chris is going to look after you, Mike. He said, is there a recommended percentage of equity to have before looking at another investment property?
Only the minimum amount, really. It depends. That depends on your personal situation. But really, the only amount you need is the minimum amount for the property that you're purchasing. I'll touch on this in a little bit more detail tomorrow, but that can be dictated by the type of investment property that you buy. If you buy an in situ existing house, you're going to need 40% deposit on that, or equity of 40%. If you buy a new build property, it can be as low as 10%. So really the recommended, if you wanted to purchase one now, the recommended equity level would just be the minimum amount. But again, it's going to come back to affordability and does this property work for you?
Yeah, and I think that affordability point is a really good one to touch on as well, Mike, that you might be able to get the debt, but if you look at the rent, the mortgage cost, the other costs associated, rising interest rates, is it the right thing for you to take on more debt? Will you be okay if interest rates go up? They're all important things to think about as well.
Yeah, and we factor those into the mortgage application as well. And when we run our calculations, like we stress test them and do all that sort of thing. But again, it's just going to come down to does this specific property that you want to buy work for you? But yeah, literally you just, there's no recommended amount, but the minimum you need is usually, 10% for a new build or 40% for an in-situ property.
Nice. Okay. Do you recommend paying extra on mortgage or investing separately, i.e. buying shares?
Yeah, I guess I'm probably going to say pay down the mortgage, unless you've got that hot insider stock tip. And if you do, put it in my inbox. My usual advice is to pay down the mortgage first, so long as that mortgage is on your owner-occupied property. Now, investment property debt is different to owner-occupied debt. You want to, we sort of see that investment property debt as good debt, whereas that owner-occupied debt should be being paid down. You just need to think, can you outperform the interest that you're being charged on your mortgage? And you need to think of that on a after fees, after tax, after inflation adjusted basis.
Yeah, I think in the world of Sharesies, where Sharesies and those platforms have done a world of good because it's created accessibility, right? Which is really important, and compressed fees, which I'm a fan of all of those things. However, what it has resulted in is everybody having a Sharesies account, a lot of those people probably having mortgages. Firstly, if you're buying shares, do you know what you're doing? How well diversified is that portfolio? Are you using funds? Are you picking direct companies? How are you picking whatever you're picking? An example is last year, the S&P 500 went up 20%, the NZX 50 went down 5%. So there needs to be some logic, not just around diversification, but diversification around different countries as well. But you also need to be thinking about, if you have a mortgage, and say a mortgage rate is 4.5%, and you can make an 8% return on an index fund over the average of the long term, and there will be volatility along the way. First, you need to take off tax. That might pull you down to 6%. Then you need to take off inflation. That might get you somewhere to about 4%. So then if you're thinking about, and inflation is important because you're not spending the money from the investment fund straight away, but you save the interest on the mortgage straight away by paying off more debt. So it gets very close in terms of mortgages versus the investment funds. And that's, a lot of people just look at the top level number and go, wow, look how much money I'm making. But you got to really make it so it's apples versus apples.
Yeah. And it's not sexy. Like, it's not the fun thing to do just to pay off a little bit more of your mortgage, but
it's really not.
Yeah, it's sort of the reality.
Yeah. Another question for you, Mike, making sure you feel the love, that you're feeling valued. How much extra can I contribute to my mortgage each year? Are there break fees involved, etc.?
Yeah, cool. So I'll take it back a step. You should be having a really thorough discussion with your broker or your banker about this, about setting up or structuring your mortgage in the right way, so that if you do want to make additional payments, you can. Each bank treats repayment on the loan slightly differently. For example, at ANZ, you can pay 5% per annum over and above the minimum at any time without incurring bank costs. Westpac will let you pay or fix your repayments at the start of the fixed term to whatever you want. Doesn't matter so long as it's above the minimum. So each bank treats it slightly differently. So I can't tell you in your scenario because I don't know what bank you're at. But the other thing to keep in mind here is, how does your household get paid, or how do you get paid, or you and your partner get paid? So if you are both stock standard salary, PAYE, full-time employment, and your income is unlikely to change over the next 24 months, then what you want to do is work out that budget right at the start of your fixed interest rate period, set the repayments at the start, and just keep them there the whole time. If one of you gets lump sums or bonuses, or there's a combination of lump sums coming into the household and a steady income, perhaps you want to have someone on a revolving credit or a floating facility so that you can make those repayments whenever you want. Again, different banks treat those accounts slightly differently. If you're at Westpac, for example, any floating loan you can usually redraw straight away. At other banks, it's only a revolving credit facility that you can redraw on. So there's no hard and fast rule because I don't know what bank you're with. But yeah, I guess you can make overpayments. It's just about how your loan is structured at the moment. And remember, you can partially break a loan. You don't have to break an entire loan balance. So if you want to pay off $10,000, you can break $10,000 of that loan and leave the rest on that interest rate. Again, depends what bank you're with, but most of them will do that.
Phenomenal answer, Mike. I think we're all done with the questions, unless you can see anything else on Slido, Mike, because
let me have a quick look.
You could see some stuff that I couldn't see. Just while Mike is having a look, tomorrow we're doing our final webinar, which is Investing 101. Tell your colleagues, go, hey, you guys need to see this webinar. There's good stuff in here. We're going into shares. We're going into KiwiSaver. We're going into investment property, a lot more good stuff tomorrow. Mike, any questions?
No, that's it.
Great. We're all wrapped up. 2:50, not a bad go for Mike and I, only running 5 minutes over. Thank you very much. We'll see you tomorrow.